Yes, so I want us to look on the financial statements, which are prepared by the entities or basically companies which are involved in agriculture or farming activities. And majorly we have three um, financial statements which are prepared. And basically financial statements are final accounts. These are the accounts to be prepared at the end of the year, or the financial statement to be prepared at the end of the year, majorly to determine how that entity is performing, or basically how different departments within that company are performing. So here, the financial statement prepared include number one, the revenue account, and number two, we have the income statement, which is also known as the statement of a profit or loss. And number three, we have the statement of a financial position. I want to start with the first one, which is the revenue account. The revenue account. Now, a revenue account, basically, this is a final account which is prepared to determine the performance of different departments within a farming business. So when we talk about department, what do you mean by department? Basically, when we talk about department, assuming we have a company, that company is involved in two major farming activities. For example, that company is involved in dairy farming. In most of the cases, if a company is in dairy farming, you'll be able to see a company will also undertake another farming activity which is related to that. So you may see that this company is also involved in maize farming. Maize farming. So in this case, we can refer to this as different department. So dairy farming is a department on its own. Maize farming is a department on its own. It is obvious that this company, at the end of each year, we want to know how each of the department is actually performing. So what that company will do is basically to prepare something called the revenue account. And this revenue account is prepared to determine the performance of each department, Majorly here we have two types of revenue accounts which are prepared. Types of revenue account, we have two of them. Types of revenue accounts, we have two. One, we have something called the crop revenue account. And then we have something called the livestock revenue account. Crop revenue account and the livestock revenue account. Now, for the crop revenue account, this is basically a revenue account which is prepared to determine the performance of any form of crop farming. So a farmer may be involved in maize farming. Maize farming is a type of crop farming. A farmer may be involved in bean farming. So he must prepare something called the crop revenue account. So therefore, the crop revenue account, this one is prepared to determine the financial performance of any form of crop farming, any form of crop farming. On the other hand, if basically a farmer or an entity is involved in any form of livestock keeping, so he need to prepare something called the livestock revenue account. If you have a company which is involved in dairy farming, you have to prepare a revenue account which is called the livestock revenue account. So therefore, what is important is that the revenue account is prepared basically to determine the performance of different departments within a farming business. And actually, in this case, we have said that we have two types of revenue account: the crop revenue account and also the livestock revenue account. In most of the cases, once you come across these questions, the examiner will not tell you which revenue account to prepare. But once you're given, for example, information about dairy farming, you're given information about dairy farming, you're given information, for example, on maize farming. Is basically upon you to know that here you're going to prepare a revenue account which is called livestock, because dairy farming is a form of livestock keeping. So here you'll prepare something called the livestock revenue account. Here you'll prepare something called what? The crop revenue account, the crop revenue account. Now, how do we prepare this particular account here? The revenue account. So this one is basically prepared using a T format, a T format. So if we use a T format, we prepare these using the same format as the ledger account. Basically, we know a ledger account has a debit side and a credit side. So to prepare this particular account here, that is the revenue account, we prepare it using a T format. T format means that this will be the debit side and this will be the credit side. Also, in most of these particular questions, you'll be given a question whereby a company or an entity is involved in both dairy farming or is involved in form of livestock keeping and also some form of crop farming. So meaning that you have to prepare the two revenue accounts, the crop revenue account and the livestock revenue account. Do you prepare those accounts separately? No, you just prepare those two accounts concurrently, or actually you prepare them together. So what happened here, you have two columns. You have two columns on both the debit and the credit side. So this will be the crop revenue account, and then you have the livestock revenue account. The same case on the credit side, the crop, and also the livestock revenue account. Remember, I've said that this revenue account is basically prepared to determine the profit or basically loss of each department, So how do we compute the profit or loss? Generally, we know to compute the profit or loss, when preparing the income statement, we always start, or actually to compute the profit or loss, we take the sales. This is something you know from financial accounting. We take the sales, we minus the cost of sales. This will give us something known as the gross profit. The gross profit. Once we get the gross profit, we proceed and we less the expenses. That's basically what we know, that to compute the profit or loss, we take the sales minus the cost of sales, minus the expenses. So, but also we know that how do we compute the cost of sales here? The cost of sales, this one is computed by taking the opening inventory. This is something you know from financial accounting. We add purchases minus the closing inventory. That is how we compute the cost of sales. And then to this, we have said we proceed and we less what? The expenses. So I want us to open this bracket because we need to have this equation. It will help us in terms of understanding how we prepare this account, what we record on the debit side, what we record on the credit side. So to compute the profit or loss, we take the sales, we open the bracket here. Basically, remember here we have one, which is basically silent, or which so we need to multiply everything here with the negative one. So this times this, which will give us negative opening inventory. This times this will give us negative purchases. This times this will give us positive closing inventory. And then we have what? We have expenses. So this is the equation which will help us in terms of understanding how we prepare this account, Now, anything which is positive from this equation, all items which are positive, sales, and closing inventory, we record them on the credit side of this account. The sales, the closing inventory. Those items which are negatives, this one, and this one, we record them, this one, and this one, we record them on the debit side of this what? account. So basically, what that means is that on this side, we record the sales. So automatically, you'll be given various items of sales. For example, in relation to the crop farming, you can be given sale of dry maize. You can be given sale of green maize. You can also be given sale of the maize stock. If you are a maize farmer, what do you harvest from your farm? Green maize, dry maize, and also we have the maize stock. So you can be given sales of all those items. If you are maybe a dairy, you are involved in dairy farming, what do you sell from your dairy farming farm? You can sell milk, you can sell some manure from your farm. You can also sell maybe like some of the cows have died, you sell them as carcasses. Sasa, you can be given sales of various what items. So those items of sales which you are given, you record them on which side? On this side. And also on this side, we record the closing inventory. Equal in this case, you can be given various items of closing inventory. For example, you know what is used in the farm. Things like maybe the maize seeds, the fertilizer, you can be given the closing inventory for that. Here, what is used in the dairy farm, in a dairy farm, the dairy cattle feeds, maybe things like what? Things like maybe salt, which is used in terms of, or which is given to the dairy cows and so on. So you'll be given various items of the closing inventory. So we record the closing inventory and the sales on the credit side. Then the other items which are negative, including the opening inventory, including purchases, including expenses. And in this case, what we record here are the specific expenses. Specific expenses means we record expenses specifically relating to crop and livestock. So because you can be given some general expenses, the general expenses, we use them in preparation of the income statement or the statement of profit or loss. So here we take into account the specific expenses relating to crop farming, relating to livestock farming. Sasa, yes, after doing that, we then we then balance our account. We then balance our account here. We then balance our account. I hope you can be able to recall how we were balancing the ledger account. If you can't be able to recall, I will be able to remind you, maybe when doing a question. And after balancing this revenue account, if you get a balancing figure on this side, that is a loss for the year. A loss for the year, a balancing figure on this side. But if you get a balancing figure on this side, that would be the profit. Forward, the profit for the year. The profit for the year. That's basically how we prepare the revenue account. Basically, which you have said is an account which is prepared to determine the performance of each department within a farming business. Within a farming business. Are we together up to that point? If we are together up to that point, I want us to move and basically we look on how we prepare the income statement. Are we together up to that point? Is there any question before we can be able to move to the other item? Are we together? Are we together up to that point? Lucy, Noor, Felix, Aaron, are we together up to that point? Juliet, are we together up to that point? Are we together up to that point? Remember, this is the format we will be using, sorry. This is the format we will be using in our next class to do a question from a past paper. So if you have any question, make sure you ask. Okay, so I think there is none. So what we need to do is then we proceed and we look on how do we prepare an income statement. How do we prepare an income statement? Now, this income statement is basically prepared to ascertain, to determine the performance of the entire company. Not the performance of different departments, but this one is prepared to ascertain, to determine the performance of the entire company, which is involved in agriculture or farming activities. So what is the performance of that company? What is the performance of that company? So therefore, we can say, first of all, this is prepared to do what? To determine the financial performance financial performance of the entity involved in farming activities. So this one is not prepared to ascertain, to determine the performance of different departments, but this one is prepared to do what? To ascertain, to determine the performance of what? The performance of the entire company. So how do we prepare this one? The statement of a profit or loss. Statement of a profit or loss. Statement of profit or loss. How do we prepare this one? We prepare this basically by comparing the incomes of this company with the expenses. Incomes with the expenses. So always we start with the incomes. And for the incomes, we start with the profit which was generated from the different departments within that company. So that is now the profit which was which we computed from this account. So if we had some profit from the two farming activities, profit for the year from the crop, and also from the livestock revenue account, basically we include that here as the first incomes. And then to this, we add any other income. We add other incomes. The other incomes which such a company may be having is something like investment income. This company may have invested in shares or may have invested, for example, in government securities. It is earning some income. So we get the total here, which now would be the total incomes. So after getting the total incomes of this company, we then proceed and we less the expenses. Equally, the expenses which we less here are the general. The general, what do we mean by general expenses? These are those particular expenses not relating to crop farming and not relating to livestock farming. These good examples of these expenses include something like depreciation of assets. Maybe there are some assets which are used within the farm. They depreciated, they lost some value. That is a general expense because we can't be able to say that these assets are used in a certain department and not in another department. They are assets generally used in the farm. Another good example is the salaries which are paid, or the wages which are paid to the farm workers. You see, if you are a farmer and you have different departments, dairy farming, maize farming, in most of the cases, the workers will be working within your farm will be the same workers. So who work in different departments. So you pay them salary. Is that salary related to a certain department? No, it's a general expense. So therefore here, what we consider are the general expenses, including depreciation of assets, including maybe farm work wages, etc. So then we less that from the total income. Mostly, if this now a company, what we get here is the profit before tax. If this is a company, profit before what? Profit before tax. Profit before a tax. So after getting that profit before tax, automatically we proceed and we less the tax. We less the tax. We less income tax expense. Income tax expense, and we get profit for the year. Profit for the year. So to this profit for the year, there is something we add here, and that is the retained profit the retained profit balance brought down. So this is the retained profit, which was retained, or the retained profit from the from the previous year, the retained profit from the previous year. And then we get something called the retained profit balance carried down. Now, this retained profit balance carried down, this one is recognized as a component of equity, in the statement of financial position. When we are preparing the statement of financial position, this will be a component of equity. I hope you can be able to remember what equity, what is contained within equity. Equity comprises of share capital and reserves. So the retained earnings is one of the component of equity. So basically, that is how we prepare this income statement, basically, which you have said is prepared to ascertain the performance of this company, which is involved in agriculture or farming activities. Now, finally, we prepare the statement of financial position. So the statement of financial position basically is something we have come across in so many topics. Actually, I think in almost all the topics which you have done, we have come across this statement of financial position. Now, a statement of financial position, this one is prepared to determine the financial position. This one, we prepare it to determine the financial position of an entity at the end of the year. So it is prepared to ascertain financial position, the financial position. Just a minute. Yes, just a minute. My body is moving here. My body is moving. Okay, so I think it is now sorted. So in this case, we have said that this one is prepared to do what? To ascertain the financial position of the entity at year end. So we prepare this one to determine what is the financial position of this entity at the end of the year. The other thing we also need to recall is that this one is prepared based on the accounting equation. So we can say it is prepared based on accounting equation. Who can be able to remind us what does the accounting equation state? The accounting equation is something basically you came across in financial accounting somewhere. Accounting equation, what does it state? Yes, I'm told it states what? It states that if you take what? Assets, or A, that would be equal to E plus L. What does the accounting equation state? I'm waiting for the answers here. I'm not seeing any answer from Rachel, from Lucy. Noor, what does the accounting equation state here? Accounting equation. What does it state? What does the accounting equation state? What does the accounting equation state? I'm waiting for the answers here so that we can be able to move. The accounting equation, what does it state? What does it state? What does the accounting equation state? Yes, the accounting equation states that if you take assets which is represented by A, capital A, this one will be equal to capital. Capital is also known as what? Is also known as equity. Is also known as equity plus liabilities. Plus what? Plus liabilities. Plus liabilities. That's basically how what the accounting equation states. So meaning that when preparing this statement of financial position, we basically prepare it based on that equation. We take assets, basically which we classify into two. We get the total, and then after getting the total, we record equity. Equity basically comprises of what? Comprises of share capital and reserves, and then we record the liability. So mean that in preparation of this statement of financial position, we start by recording assets, and basically in this case we are saying asset. This is something we know. Asset, we classify them into two: the non-current assets and also the current what? The current assets. The current assets. We classify them into two: current and non-current what? Assets. And then from there, we basically get the total assets. The total assets. And then from there, we proceed to record equity. Equity, this one comprises of share capital, and reserves. So reserves comprises of things like the share premium, the retained earnings, the revaluation reserve, and so on. And then we get the total equity. And then from there, we record the liabilities. So for the liabilities, we classify them into two: non-current liabilities and also current what? Liabilities. Current liabilities. And then what do we get here? We get total equity and what? Total equity and liabilities. Total equity and liabilities. And actually, whatever you get here in the total asset should always be the same. It should always be the same with the total equity and what? And liabilities. Total equity and liabilities. So that's basically how we prepare our statement of financial what? Position. Therefore, generally those are the financial statements which are prepared by those particular companies which are involved in farming or agriculture activities. The revenue account, which I've said is prepared basically to determine the performance of different departments within a farming business. We have the income statement or the statement of profit or loss, which I've said is prepared to determine the performance of the entire company, the performance of the company involved in farming activities. And then we have the statement of financial position, statement of financial position. I want us, maybe we just take the next like 5 minutes because I want us to be wind up. We take the next 5 minutes and basically we look on how do we account for specialized transactions. How do we account for specialized transactions? Specialized transactions. So when talk about the specialized transaction, this basically the transaction will only come across whenever you are required to prepare a financial statement of a company involved in farming or agriculture activity. So some of the specialized transactions you may come across is one, something called interdependence of department. Interdependence of department. Interdependence of department. So what do you mean by interdependence of department? Interdependence of department basically this whereby the output from one department is an input in another department. Output from one department is input in another word department. A good example is maybe the manure from the cow shed, the manure from dairy farming department will be used in planting the maize. Used in planting what? The maize. Or in other terms, the manure from the cow shed, this basically is used in the farm, used in the farm to do what? To plant maize. To plant what? Maize. Automatically, this manure is an output as far as the dairy farming is concerned. Whereas in maize farming, this is what? This is an input. How do we account for this? Now, the producing department, like in this case, the dairy farming will account for that as sales. So basically, what should happen here is that this company should determine the market value of this manure. What is the market value of this manure? Market value should be determined, and that should be accounted for as sales in the producing department. So the producing department account for that as sales using the market value. What is the market value of that manure? If this company went to the market to buy that manure, it could have been bought at how much? Account for that as sales in the producing department. And then the consuming is like the using department. The consuming department will basically account for this as what? Will account for this as purchases. Will account for this as what? As purchases. Manure is not a waste. Someone is saying manure is a waste. No, manure is not a waste. Manure is basically something which is of value. Yes. So this one will be accounted as sales. This one will be accounted as purchases within the revenue account. Within the revenue account. Now, another good example of this is basically maize stock. Maize stock. After harvesting maize, either green maize or dry maize, we have the maize stock. So basically, that maize stock, how can you use that maize stock if we are a farmer? Maybe you are involved in maize farming. You are also involved in dairy farming. How do you use that maize stock, which remains after harvesting your maize? How can you use this one, Lucy? Yes, you use this one to feed your dairy cows. You can use this maybe to make some silage to feed your dairy cows. Cows. So therefore, that is still another good example. The maize stock from the maize farming is used to feed the dairy cows. So from maize farming, it is an output. To the dairy farming is an input. The producing department, maize farming, account for that as sales. The consuming department account for that as what? The consuming department account for that as purchases. Then another good example, or another the other special transaction that is the farm produce, which are consumed by the family. For example, you are a dairy farmer, and maybe on daily basis, there is that milk which is consumed in your family. So that is a farm produce which is consumed by the family members. You have to account for that because basically you are in business. One, what you do, determine the market value of this farm produce. This one should be produce. Determine the market value of the farm produce. And then how do you account for this? One, you account for this as sales in the revenue account. So if the farm produce which is consumed is milk, so milk is from dairy farming. So that will be accounted for as sales in the livestock revenue account. Number two, you also account for this as what? As drawings. You also account for this as drawings. Drawings, this one is deducted from capital. Deducted from capital. It's just like where you have a business, but you're taking some stock from your business for your personal use. You're taking some goods from your business for your personal use. That is drawings. It reduces your capital. So any farm produce consumed by the family members, We account for that as sales. We also account for that as what? As the drawings. It basically reduces the capital. It also reduces the capital. Then number 3, we have farm produce. Farm produce, which are consumed by the farm workers. Consumed by the farm workers. The farm workers. So these are the farm produce which are consumed by the farm workers. Maybe you have some workers who work in your farm, some employees who work in your farm. You give them some milk or other farm produce. So by the end of the day, remember, you are in business. You can't give them those farm produce free of charge. So once you give them, you will have to recover this from their salary. So how do you account for those particular farm produce? One, you account for this as sales. This as sales in the revenue account. In the revenue account, and because then this one will be used in terms of reducing their pay. You're going to reduce their pay. If you are supposed to pay them 100,000, they consumed farm produce of 20,000. You'll pay them 80,000. You have to recover that. You're in business. There is no way you're going to give your farm produce free of charge. So therefore, this one is also accounted for as an expense. As an expense in the income statement. In the income statement. When preparing the income statement for the whole company, you also account for that as an expense. You are using that, you are giving them farm produce, and you are also recovering that from their salaries. So then from there we have number 4, we have farm produce, produce either donated, farm produce which are donated. Farm produce donated, these are farm produce given free of charge, either to family members, either to children home. So such farm produce which are donated, we also account for this as sales within the revenue account. Within the revenue account. And number 2, once you have given some farm produce free of charge, these are loss to your business. Also account for that as an expense. Account for that as an expense in the income statement, not in the revenue account, but in the income statement. Account for that as an expense in the income statement. I think finally we have family labor, or basically we have labor provided by family members. By family members. So labor which is provided by family members. Your members of your family work within your farm. Work within your farm. So in this case, how do we account for this? 1, we account for this as additional capital. Additional capital. This basically where you decide to work in your business and you're not paying yourself. It basically means that you see, whenever you're working in your business, you should pay yourself, especially if it is a company. You're a director, you should pay yourself. So, but in this case, you are working free of charge. It basically means that the money which you could be taking as salary, it is retained in your business. If it is retained in your business as a profit, it is increasing your capital. That's why we are saying account for that as additional capital. And number 2, you also account for that as an expense. As an expense in the income statement, because if you never work in your farm, if you never work in your company free of charge, it is obvious that you could have employed some employees. You could have engaged some employees to work in your farm. Automatically, you could have paid them. So therefore, any farm or any labor which is provided by the family members, this is basically how we do what? How we account for this, how we account for it. Account for it as additional capital added to the capital. And then number 2, we are saying you do what? Number 2, you do what? You do what? You account for that as an expense in what? In the statement of profit or loss, or in the income statement. So basically, those are some of the specialized transactions you must be in a position to deal with, specifically when preparing the financial statement of an entity or basically a company, which is involved in what? In farming all agricultural or agriculture activities, So, and basically for today, we are going to stop at that point. Once we meet in our next session, we will be able to look on a question in relation to this. And I think the latest question was in November 2020, question 5A. Question 5A, that is the question we're going to do once we meet in our next class, basically on how to prepare the financial statements of an entity or basically a company which is involved in farming or agriculture activities. But even before we meet in our next class, which will be on Thursday, So make sure you have gone through what you have discussed, especially on regarding how to prepare the financial statements of a company involved in agriculture or farming activities, and also make sure you remind yourself on how to account for all these specialized transactions, because you'll be able to see that that is basically the knowledge which you need to have for you to be able to prepare this. That was her? Yes. So for today, I want us to stop at that point. I don't know whether there is any question before we call it a day. Do we have any question? Do we have any question before we call it a day?